Despite supportive headlines, natural gas futures saw little upside momentum this week, pressured by stubbornly high production levels and a larger-than-expected storage injection. Bullish catalysts, including forecasts of a blistering late-June heat wave and escalating Middle East tensions, proved insufficient to counter the weight of tepid domestic demand and ample inventories. However, geopolitical risk emerged as a late-week wildcard. Israeli strikes on Iranian military targets stoked fears of wider regional conflict, particularly around the Strait of Hormuz, through which nearly 20% of global LNG volumes transit. In a reactive move, Israel shut down the Leviathan gas field, suspending exports to Egypt. While U.S. LNG flows remain unaffected, the ripple effect reverberated through global markets, lifting benchmark gas prices and attracting speculative interest into U.S. futures as a hedge against global supply disruptions. Meanwhile, weather forecasters project a scorching heatwave from June 19 to 26, targeting the southern and central U.S., with potential eastward expansion. Temperatures in Texas and the Southwest are expected to surge into the 90s and 100s, sparking hopes for a surge in power sector gas demand. Yet, despite the looming heat, the market remains skeptical. Demand metrics have yet to show meaningful gains, and weather models still lack firm consensus. For now, sentiment remains guarded. Until heat-driven demand materializes or inventories begin tightening, bulls face an uphill battle in a market still dominated by supply-side excess. The weekly chart outlines a well-defined trading corridor for natural gas. Support is firm at the 50-week moving average of $3.14, reinforced by the recent swing low at $3.25. On the upside, key resistance levels include the $3.80 pivot and a broader ceiling near $4. Friday's close at $3.61 leaves the market firmly boxed in, with rallies likely to stall below $3.80 unless a clear breakout catalyst emerges. Absent a verified heat wave or a sharp disruption to LNG flows, the market is expected to remain trapped in this range, held down by strong production and lackluster demand. A decisive break below $3.44 could shift momentum lower toward $3.25, while upside traction would require sustained weather-driven demand or an escalation in geopolitical risks. For now, the bias leans neutral to bearish, with speculative upside hinging on near-term headlines. Please like, subscribe, and comment to support the channel. See you in the next one.